We're seeing a big divergence in the consumer trade today. Discretionary stocks are the best performers, while staples is the only sector in the red after Powell paved the way for a September rate cut. My next guest expects that divide to remain. Joining me now is Savita Subramanian, head of U.S. equity and quantitative strategy of BofA Securities. And Savita, it's great to have you on. This divergence we're seeing in the consumer and specifically in the stocks related to the consumer, what do you break that down to?
I think part of it is just the idea that we are starting to see a pickup in business activity. We've got a relatively, maybe a slightly more dovish Fed than we were expecting. So cash yields are capped, borrow rates are capped, and you've got a mini pickup in demand. So I think what we're seeing is really interesting because staples is actually harder hit by inflation than discretionary stocks. And one of the reasons we've been underweight consumer staples and overweight consumer discretionary is that where we're seeing the real fraying in the economy from consumption is in that lower income cohort. Just because inflation and extra costs are a bigger share of their wallet. And those spending patterns tend to be most pronounced within low price point retailers like personal products, supermarkets, et cetera. And I think that what we're seeing today is the idea that the middle to higher income consumer is fine. The economy is okay. The Fed is going to put a ceiling on short rates, but that lower income consumer could continue to struggle against this sort of stickier inflation in food, rent, you name it. There's a higher level for most spending categories that hurt that lower income wallet.
Yeah. I mean, it was interesting to hear Fed Chair Powell basically suggest that the inflation they're seeing from tariffs, which showing up in the data that he expects it to be a one-time thing, or at least I'll use the word transitory, my word. How does that, so given the fact that we have this likely rate cut on the table next month, how does that affect the lower income consumer and this dynamic, if it does?
I don't know if it matters as much to consumption trends. I think what's really critical for consumption is employment, and the Fed is less important. I mean, as long as the Fed's not hiking interest rates, it's a decent backdrop for consumers. But U.S. consumers tend to spend on stuff until they lose their source of income. So I think what we would be more worried about for a broad-based swoon in discretionary and staples is massive job losses, layoffs, et cetera. We're tracking them this earnings season. We've been watching the data, slavishly, and we're not necessarily seeing anything that negative in terms of really weak employment data. But that would be the factor to watch as it affects consumers. I almost feel like the Fed, especially just cutting 25 basis points, is less important for consumer stocks than it might be expected. As long as the Fed is not aggressively hiking interest rates, we think the consumer can do okay in this environment.